The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of AKERS Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Hey, welcome to Winning in Retirement. I'm Brian Akers, president and founder of AKERS Financial Group, and we welcome you to our show on Winning in Retirement, radio podcast put on by AKERS Financial Group. Here with me today is Alex Monk, financial advisor, certified financial planner, practitioner from AKERS Financial Group. Good morning, Alex.
Brian, thanks for putting on the podcast, the show. I love it.
This radio show is going to be a good one because I got you on there with me. And what I got to do is drag out all the knowledge, all the information. Are you ready for that?
Yeah, you can go back in the catacombs. Are you ready? It's scary in there.
I want to call the show active, so I need you to be active, Alex.
All right, but I'm sitting right now.
Yeah, we're going to do a stationary active Alex, which is going to be weird. But active is a word we want you to learn today. Active, and we're going to tie it to something called money management. Active money management. So our goal today is for you to learn basics of that, how we at AKERS Financial Group, how we actually do that, and how we implement it for our clients to make their money last a lifetime. Because we believe that winning in retirement is working hard during your life, saving your money, putting that money aside, and then one day you use that money to supply what you need for the rest of your life.
So you're telling me that this winning in retirement will also help you manage your money throughout retirement?
Absolutely, because sometimes when we say the word planning, they click the radio, they change channels. Planning is too much work. But what we want to do is this. Let's talk about managing the money. That's always fun. And then we talk about what we do, how we do it, and how we apply planning to it. You don't need to know the inner working of all the application, but how do we actually do it for clients when it comes from planning to implementation?
You know, it's funny. Some people, they want to know everything about their financial life from start to finish, as we start, right?
Yeah.
And I'm already looking down those roads. So yeah, let's talk about it. Some people have no idea what's coming. They're just oh, you guys got it. But when it comes to money management, it's such a, I don't want to say we started with the word active, right? Proactive, reactive, all these different things. Active means things are changing, moving, right?
That's supposed to be the answer.
So you need to have somebody that's doing it all the time for you.
Yep.
So it's extremely important, right? As the world changes, as life changes, as your stages of your life, but also different parts of the market. So there's so many things that go into it. But I think the key word there is active.
Yeah, so today's show is we call it active money management. We're going to apply that to really generally what is the right answer. And as you think about the show, you think about, should I have money management? Should it be actively managed by an advisory firm? What should I do? And we won't give you the reasons why it's a good idea, especially to check us out, to compare what we do to what's going on for you, what your experience has been. The markets have been good the last decade. They've been pretty good. Up and down, a couple bad years, of course. That's a pretty normal stock market. But then the market's had some really great returns the last decade. And the hardest part would be is what to expect for the next decade. And when you think about retiring into a market or into a market that could be more volatile, which is pretty normal when we think about all my clients over the last 37 years, is markets change. They go up and down. They have volatile times, sideways times. They have down times. They have up times. And the idea is diversification is a great thing to do, but you can't just set things and forget them, which a lot of advisors seem to do for people that we see. When clients come in for a free review, we see a lot of things where, oh yeah, I haven't met with them in years, but this is what they did 5 years ago or 10 years ago, or I did this in 1998, and that kind of thing.
And they already have a money manager, right? So a lot of these people already have this service, and it just doesn't match up to anything that's going on,
Yeah, and so what we're going to talk about today is there's 4 different quarters. We're going to divide our conversation in a bunch of different ways, but one of them is going to be second quarter, be about active versus too active. Then we're going to talk about advisors and the questions they ask. Do they really need to ask the questions? And what if your advisor's not asking any questions? Is that good? Is it bad? We're going to talk about that. Then we're going to finish up with this whole concept of what kind of risk do you really want to take when it comes to your retirement money that you have to count on for your lifetime? How are you going to balance this all out? So as we start with AKERS Financial Group. Please explain, Alex, how AKERS Financial Group is an independent financial company and sort of how you and I are licensed, just the basics.
Yeah, so we're independent, meaning we report to our clients first.
Right.
We have larger companies for oversight. We have broker dealer. We have registered investment advisor. We're also licensed through insurance, which is a completely separate regulatory environment, all that thing. And you have P&C, I believe. So we're basically licensed and dangerous to do just about anything financial.
Right. So by having license really in 3 different ways, that provides multiple ways of handling what people might already have in existence, but also gives the ability to be a financial advisor that implements whatever you need, rather than we have one product on the shelf or 3 products on the shelf ready to give it to you.
And let me just kind of jump in and explain why that's important.
That sounds like a good reason.
So as a certified financial planner, right, we have to be always a fiduciary.
Yes.
And, one of the beautiful things about the way you set this company up is if there is something that exists out there, we can go get that for that client if it's the right answer.
Correct.
Now, that's not always the easiest thing for AKERS Financial Group, but that's not what we're here for, right?
It's hard to track and to follow it, and sometimes the licensing takes a while, but ultimately we can figure out how to deliver what that client might need at that moment.
Right, and where if you go to something, a big Wall Street firm, something like that, they may not have a lot of these products available. And that, to me, for me to be able to say, hey, well, this is really what this client needs, but I can't do that because I work here.
Yep.
That just doesn't, my brain just like flashes red and says, doesn't make sense, can't compute. It's kind of like how I was in chemistry and I just shut down. I'm not a science guy.
All right. So, we're trying not to make it the Alex Monk show about his life and struggles of chemistry class. But that does apply to financial planning, though, because we have to have a chemistry, Alex, you and I. You and your clients have to have a chemistry where you can actually listen to what's going on to them and then apply it. And then the hardest thing about setting up a company was, how can I apply it and do what the client needs when you're told from above, from whoever you work for, this is what you have to sell? And so that's why the answer had to be independent. So AKERS Financial Group was founded over 19 years ago to be independent, to really design what the client needs. So the client drives what needs to happen for them, and then AKERS Financial provides it. So we do money management, actual active money management. We do that through a third-party firm. Now, AKERS Financial Group has an investment committee that Alex Monk is the head of. Can you explain a little bit about what their investment committee does?
Yep. So back to that independent thing, our main investment style or theory, I guess, if you will, when it comes to our active or aggressive or risky money, is a core and satellite approach. Okay, so our core is going to be this, just the main exposure that's well diversified, and I'm talking domestic, meaning U.S. markets across the size of different companies, and then international, gold, commodities, things that, just everything, right? A well-diversified portfolio. And then as you have more and more money to manage, you can add on specific things, individual stocks, dividend style, growth style, value style, buffer, all types of different stuff, but as a satellite. So like the top-down approach, we want to make sure we have a core of exposure to our equity. And at our investment committee, we go out and we find the best managers in those spaces.
Yeah, so technology has given us the ability to deliver whatever is the best in the category. We build the allocations through the investment committee and our research people, and then we work on that multiple portfolios that we work with Brookstone. They actually manage portfolios for us, and they manage a lot of ones on their own too, and we get to pick and choose, build it all in one account, which is sort of called sleeves, each position. But this investment committee at AKERS Financial Group is all the advisors. It's led by the Alex Monk and myself, and what we try to do is truly develop portfolios that can be designed to have less risk in the market, designed to deliver what we want when it comes to the future of what's going on in the markets on a less risk and lower beta than the market itself.
Oh, beta. So
I was trying to keep it simple. I was debating to say beta or not, but beta is the risk level. If you have your hands and you put them in front of you, if both hands go up and down together, that means you're tied to the market. That means you have a 1-to-1 relationship with the market. that happens to be called 1 beta. If one hand, which is the market, goes up faster and down faster, and then your investments, that means that your investments have less risk than the market. You have a lower beta. That's a simple.
Yeah, and then there's alpha, which is upside.
Oh, you get too deep.
You can't talk about alpha, beta without alpha. I don't know.
Well, alpha is the value of the manager, and that's why picking the manager is very, very important. How you put it together and the allocation is the other key factor. Really, the driving factor is the allocation. Yes, I have a Virginia Tech finance degree from a long, long time ago, and that degree helped me a lot when designing portfolios, but then the application to the client has been a variance of what they recommended versus lots of research, lots of information, a lot of studies at different places over the years to develop what I want to do for my clients, because I want them to take the least amount of risks to reach their goals, not the most amount of risks. And these are all the topics for today. We're talking about active management.
And we're also looking for the cheapest way to get some of these things, right? Like we want...
And that keeps changing.
Yeah, and that's always a different answer. Like 20 years ago, it might have been mutual funds and stocks.
That was the only answer, individual stock. And individual stocks, you used to have trading costs to trade them. And then that changed to where you can trade really for no cost at all. And then mutual funds are not quite a thing of the past, but they're not as good as ETFs, and there's managed ETFs, all kinds of options out there for people. And the reality is, what do you do? Yeah. And that's why, as a financial advisory firm, we want to be there to help people understand that we need to make it based on you. You, the client, you, the investor, needs to have help, a coach, an advisor will come alongside to help guide you into the right decisions.
Especially making these heavy decisions, highly weighted in dollar amounts, right? The numbers get scary at the end of your career. They're huge.
And that's a great thing when they're huge. Yeah. When you're a 401k millionaire and you got to know what to do, that's exactly what AKERS Financial was built on. AKERS Financial Group, we're local, we're independent. We don't report to a big company on Wall Street or a big company in Iowa or anything like that. We report to you. We all have offices in Lutherville and Forest Hill. Clients all around the Mid-Atlantic region, all around the country, and even a few around the world. It's so easy to begin winning in retirement. Just give us a call and schedule your free meeting with one of our team of advisors by calling 833-WIN-RETIRE. That's 833-WINRETIRE. We'll give you a call on Monday to schedule your free in-person meeting. Go to AkersFinancialGroup.com or call us at 833-946-7384 to start planning for your retirement now. When we return, we will explain what is active and what is too active. Most of winning in retirement, more of winning in retirement actually, in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers from AKERS Financial Group. Here with me today is Alex Monk. We are certified financial planner practitioners from AKERS Financial Group, and we designed a show that we think is pretty interesting. It's going to be a very active show, and we actually named it Active. ACTIVE, Active is Alex.
Not to be confused with that yogurt.
We're not talking about yogurt at all.
Okay.
Or why the yogurt's active. We don't want to go there.
When you spelled it out, I was just like, this reminds me of that commercial with the lady from... Anyway, Jamie Lee Curtis. Okay.
All right.
Activa. Anyway, go on.
Back to Winning in Retirement. Yes, a radio show that we have from AKERS Financial Group. And today we're talking about active money management. We're talking about AKERS Financial Group, how we manage money for clients, how active is important to us and to our clients to deliver what they need for all the years from now all the way through those retirement years.
Yeah.
This quarter, we're talking about this little topic called, we will explain what is active and what is too active. So we're going to try to explain that.
All right. So if you have money management now,
yes,
you're probably aware that you get paperwork when they trade.
Yeah, you get paperwork, again, the mail, envelopes, or you get emails
to go in and pull these trade confirms, right? And let's say it's a busy month.
Wait, what do you mean by busy? You get like multiple mail.
Yeah, so let's say you might get mailings 10, 15 times a month if they're trading a lot. That would be a sign for like, hey, what's going on in my portfolio?
Well, some portfolios are designed or have been designed to reallocate every month.
Yes.
Even to the minute 0.0. So like basically if your portfolio has a growth fund and it goes up say 0.5% more than everything else, and all of a sudden it has an allocation 0.5% higher, they'll trim that little 0.5% and buy the 10 things that are lower and reallocate you on a monthly basis.
And in the first segment, you were talking about how money management has evolved, right? And the trading, the technology. And a lot of this is a result of technology.
Yep. So computer-driven trading doesn't really think about, you just trade a 0.1 share, and that triggers a capital gain if you own it in a personal account. So,
right. And it's probably a reinvested dividend. I mean, who knows what it is?
So what we got to do, Alex, is talk about clients that come in with existing portfolios and what we've seen. And what sometimes just make us go, oh my, is that really what happens? One of the ones I'm thinking about is the client came in, husband and wife, IRAs, Roths, and a joint account, 5 accounts, all managed identically, all 5 of them, all in the same percentage, the same things. They did the same trades every month, all 5. All 5, in my opinion, have a different objective, taxation, and should be designed in a different way.
That's not an opinion, Brian. That's a fact.
Right, but it's not the fact on advisors across the board that they're taking the time to truly say, well, this client needs a Roth IRA. How should they invest that money? Oh, this is a taxable account. Shouldn't I care about trading?
You know, I'm seeing a lot of commercials these days about, we offer planning with our active management.
Sure.
Well, you better.
Yep.
Because just what you said, it's a hugely important thing. You need to look at that client not just as, okay, husband and wife, they're moderate. So blanketly, all their accounts should be moderate. No, that's wrong, because the different taxation has different impacts on what type of assets you own. Where do you want to own your safe money? Where do you want to own your risky money?
Yep.
How are dividends paid, etc. A Roth being more aggressive. So everything you said just makes my skin curl when people do that.
Some people say, I did my Roth at the bank. It's in a Roth savings account making 0. I'm like, well, Roth is one of my favorite style of accounts. That one we can be aggressive in. It's okay to trade in a Roth IRA. It's all tax-free. The money, you want it to grow. So whatever the best growth should be, how you invest your Roth IRAs. And then we talk about joint accounts or a trust account or personal. You have to be more tax advantaged. We actually have portfolios designed to be tax advantaged. So these different portfolios, these different setups are all based on your goals, your unique situation. And that's where the concept of active is actively on your behalf, active in what's going on in the market, but also not to a point where it's detrimental to you and to your money.
Yeah, and what you're saying, the detrimental thing is what I think when people trade too much, right? I'll see clients come in for a second opinion, and I get these statements, and I'm like, man, it seems like this guy's just trying to look busy, or I'm not sure what the goal is, because none of it's making a lot of sense, right?
Yeah.
So they're either getting signals from a computer, from somewhere else, somebody else is running the money, and they really have no say in it. They're just, the front man. I don't know.
Yeah, well, some advisors, they probably have outside managers. Like we have outside managers, and then but sometimes what they'll do is they'll pick 1 or 2, and that's all they use for everybody. So the hardest part is when the people design their companies, are they really going to design a portfolio that's different from each client that they have? And that does take a lot of back office, a lot of overhead, in my opinion, because that's what I've tried to do over the years, is build the ability to deliver what a client needs. Now, some clients come in with existing portfolios where we have to work with it and sort of figure out what is best based on that.
Yeah, and top-down approach is really the key here. Where is all your money?
Yep.
That's what we need to know. I can't, someone will call me and say, hey, Alex, I got 20,000 or 200,000, whatever the number is. How would you invest it? I don't even know where to start.
Right. Yeah, and that's really going to lead to our third quarter, which is about getting to know the client and understanding what's going on with your life so we can then decide what to do. This active versus too active. What is too active? Well, let's start with the idea that you're sick of opening mail. That's one reason to consider it might be too active. Yeah. You get so many emails that you stop looking. There's too many emails. That's another example of you don't know what's going on. Now, the reality is that if you're electronic delivery, you're going to get once a year prospectuses or whatever you're invested in is going to send you information. You're going to get monthly statements. You're going to get trades. There has to be some trades. Usually there's going to be a couple trades a year in a portfolio.
At least, right?
Yeah. Well, that's what the SEC wants to see in money management. They want to see that you're actually doing something for your money that you're charging.
Right. And because the old school style was we pick a mutual fund company, you put your money and it's there forever, and you have one company that's just going to tell you how you can invest or what funds are available.
Right.
Well, technology says we don't have to do that anymore. So the funds are always changing, and they do need to be rebalanced. Like,
Yes,
things go up in different directions.
And one reason to wait at least a year is the idea of long-term capital gains rather than trading it every month where you have short-term capital gains. Short-term capital gains are at your highest rate that you pay now. Capital gains has a cap on the rate. There's a big difference on your taxation based on when you buy, and especially when you sell stocks.
Yeah.
Also, if you sell something for a loss and buy it back too quickly, and when these portfolios are computerized, they actually do that and they get wash sales. It's a bit of a mess.
Yeah, definitely a mess. And it makes the accounting difficult. And they're all trying to do something different, right? Investing, we're not trying to reinvent the wheel here.
Yeah.
We're just looking for quality, consistency, and allocation.
We've had to reinvent the wheel because years ago, it used to be that you'd have a management fee and there was cost of trading. If you are paying for management and cost of trading, you need to know that and understand that that's not the way it should be done anymore. So if your portfolio has been managed the same way for the last 20, 30 years, you need to question, is this the most efficient run portfolio for you? And that's one of the reasons we want to do a second opinion, is looking at how it's managed for you and how to build that out.
Yeah, I met with this lady recently, and she was actually with a company that her husband used to work for, and I won't shout them out specifically, but they're an upstate life insurance company, if that makes any sense to you. And she didn't know who was there. Her husband long retired, but she went there because he trusted the people that were there when he left. Well, this is 10 years down the road, and she's got no clue what's going on. And they're not talking to her. So just a quick review is we can accomplish exactly what you were doing here, and probably for half the cost.
Yeah, so what you're dealing with there is really things need to change because things don't stay the same. So even at AKERS Financial Group, how we manage money today is different than 5 years ago, different than 10, different than 20. And it has to change. And the way you design it with the ability to make changes without additional costs, without additional transactions, without additional taxation is very, very important. It all comes together to deliver you the money you need. Management and managers, advisors cost money. That money needs to be well spent. If it's not well spent, it could be a drain on your portfolio.
Yeah, so when you say well spent, you mean like you want to get value for your management fees.
You got to get value, or there's no reason to have a manager, right?
Correct. And I agree with you. So, like, how do we provide that value? People hit me up with that question all the time. Like, well, what are you doing that? And I say, well, let me show you.
Yep.
So we size positions. We try to not necessarily trend follow, but be ahead of where we think the market's going to go.
Yeah, you want to position, you want to be proactive. So the word active money management is to actually be proactive to what are the dangers that might be coming in the market. Not that we're going to be jumping out market timing wise, but maybe go from one category into another. We reallocate our allocation between different styles or different sectors and try to work with that. And that's portfolio design. And so that is something that we do with our clients' money at AKERS Financial Group.
Absolutely. And we want to have other types of asset classes in there too. Like
absolutely
owning things that act differently than the stock market ensure your wealth. They ensure your purchasing power. So there's big reasons to have well-diversified money.
Well-diversified, you might say, is not done well the last 10 years, but the reality is that it depends on how you were diversified. There are certain categories that did not do well, and those are just things you sometimes you have to have them, then other times you're going to need to get rid of them if you can. So portfolio changes are extremely important. Now, the hardest part when we're talking about AKERS Financial Group, what we have to do is really talk about money management. What we try to do for people is make sure that they're okay with their money, make sure that they have everything ready so they can have a great retirement. We want the best part of their retirement to be where they get their time back, where you decide how to use it. Before retirement, your time is tied up with other commitments, like mainly your job. A lot of that goes away in retirement. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. You go to our website at AKERSFinancialGroup.com, scroll to the schedule meeting section, and let us know you'd like to schedule your free consultation with one of our team of advisors. That's AKERSFinancialGroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person meeting. Go to AKERSFinancialGroup.com or call us at 833-946-7384 to start planning for your retirement now. So, an advisor asks you a lot of questions. Is that a good thing? We'll explain when we return in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers from AKERS Financial Group. I'm the president and founder of AKERS Financial Group, and I hired Alex Monk, and I brought Alex Monk to our show today just for you to enjoy his presence, to enjoy his knowledge, and to come across with what he recommends when it comes to this topic of active money management. Alex Monk, are you ready to go?
Yeah, and I feel like this is like I'm being paid for my time, but I also believe in the product, like one of those actual. Yeah,
it's like a real life testimony.
Yeah. So do we have to disclose that?
Well, the disclosure is this: is that we make our money manage money. That's a disclosure. Yeah. We make money. We charge fees for planning. We are fee based, meaning that we do fees and or commission both. We make money by managing the money,
and I think we're really good at it.
I think it works very well because of the fact that we talk to the client, and that's exactly what this third quarter is all about. The topic, what I teased about, the question was, so an advisor asks you a lot of questions. Is that a good thing? And I can't picture it any other way.
If they're not, there's problems.
Well, you wonder, like, what's going on? Does that mean that you're only getting the one thing they sell? Or are you really, truly someone walking you through options and what's best for you?
And I ask people a lot of strange questions, right?
Give me one.
Do you have any kids that live in the basement? You know what I mean? And what I'm asking is so many things I get with that question, right? Like, do we need to do a trust to plan for a kid that went down the wrong path and we can't let them get all the money at once? Or do we have grandkids that we need to give money to and think there's no kids in the basement? Like, you get so much out of that.
Well, like, you might be building a portfolio for their retirement, and little do you know, but by asking that question, all of a sudden, you know they need $50,000 next year or in 2 months.
Right. Well, now I know, okay, hey, well, no, they're getting married in 3 years. Yeah. Okay. So just there's things in life that you're just not going to tell somebody, but certain questions, I can get that information out of you so that I can have a 4 or 5 year projection without making you write down your 5-year plan, because I wouldn't even want to do that.
Yeah, I met this couple the other night. It's at night, so they're both done working. They're both physicians, and we're sitting down talking about life. They just got married, and they want to start on the right foot financially. And then all of a sudden they start telling me their story, because that's where I started. So, well, tell me about what's going on. And then they're like, oh, you probably don't want to hear all this. Said, yes, we do. I want to hear what's going on, how you merging money together, what kind of debt from all the being a physician. There's a lot of debt for people, and how you what's the current plan and all that. And then halfway through, she goes, I feel like a confessional. Like I'm telling you everything. I haven't told anybody all this information before. And I said, well, that means we're getting to the real information, to the real numbers. Well, the only way to start is to begin with your unique financial fingerprint. That's where you are now. Where you are now might not be where you want to be. We can assume it's not. That's why you come in to talk, is that, oh, I'm not exactly where I want to be. I want better. I want to know that I'm okay. I want to know that things are right. And so we have to begin with where you are, no matter how ugly it might be. Negative net worth and all. Or maybe it's high positive net worth, but they blow all their money.
Usually people have no clue. They come in and they think they're one way and they're not, or they're this way and they're that. And you know, you hit the nail on the head earlier. People are like, I've never told anyone all this. And I make the comparison to their doctor. I'm like, well, you know, you go to your doctor, you got no problem dropping your pants, but you're not telling them what's in your checking account. And essentially, you're telling us everything, like health issues. Like, we need to know all that so that we can help you make the right decisions for your life. And the trust is huge.
Well, you have to be trustworthy as an advisor. So that's one of the key things that I try to drive our company on, is have integrity, explain everything, the good and the bad, the good investments, the ones that are not working out right. Explain to them. Don't wait for someone to come up to you and say, oh, what's wrong with this fund here? But to really be proactively their advisor over time. Now, when somebody's a new client coming in, we got to talk about their situation. If they're in a good shape, we're going to tell people this looks like a really good thing. Does it tie to what you need? So tell me more about yourself. Well, sometimes stocks in the portfolio might be a great portfolio, but has nothing to do with what you need it to do.
Yeah. And it just doesn't make sense. It's like, okay, well, why is everything this way?
Yeah. Everything shouldn't be done the same way. And so this topic of questions, so we ask for tax returns, statements. You can tell us that how it's held, but we want to see how it's held. Not saying we don't believe you.
I don't believe anybody because it's hard. Like half the time they have no clue.
Well, they tell us the beneficiaries are fine, and if they're in a second marriage, we gotta look to make sure make sure they changed it.
And it sounds nitpicky, but when your money passes to the wrong person, or you're paying 20% higher in taxes because your asset allocation and account type for taxation is wrong, then it's a big deal.
Or like, they came in, they show us their returns the last 3 years where out of the blue, they got an $80,000 capital gain, a $100,000 capital gain, and they never had any expectation of that. It was just the trading that was done in a portfolio.
Yeah, or they just owned a mutual fund that kicks them out, and there's different ways to structure things so you can kind of avoid forced capital gain distributions in ETFs.
Right.
Because of that current little hole in the law, but the questions are the only way to find the problem and the answer.
Yeah, but some people, they're gonna take longer to trust people, which I'm okay with. Sure. And so we'll take questions from them also, and understanding that we want to hear your concerns so we can try to explain how we do it. We need to see if it's a good fit, advisor to client and client to the advisor, because you want to have an advisor that's going to listen and hear you and then be able to apply an answer that works for your situation, one that you can understand. It doesn't mean you have to be an expert, but you got to get to an understanding, to a point where you can relax and understand that things are taken care of and you're okay.
For sure. And that's the big thing I've been preaching recently to people is the money that you have and you saved, it's for you. Like, how do we use this to add value to your life? Now, I'm not going to tell you what adds value to your life, because it's different, right? It's completely different for everyone. Some people would rather have $100,000 in the bank. Some people would rather have a new HVAC system so they don't have to worry about it when they go out of town. And for me, I don't care. Whatever makes you sleep, that's what we're trying to find, right? Because this stuff is just a tool to accomplish what's going on in your life. And we need to make the money work for you.
And for the situation with a husband and wife, sometimes husband and wives agree with things, sometimes they don't. And so we're not really planning on being the referee on financial decisions. We want to provide the financial solutions based on the decision they make. So I always say, well, you got to have your subcommittee meet. How about I leave the room?
Did you say subcommittee? I like that.
I said subcommittee recently. I said, how about you guys have your own subcommittee meeting? I'll walk out of the room. And if you want to live in Virginia, Maryland, California, Florida, Tennessee, then we can figure things out. If you want to stay where you are, we can figure things out. Taxes and income and when you distribute money, when you Roth convert, does determine based on where you're living. But if I'm going to Roth convert and I'm moving to like Pennsylvania or Florida, I'm probably going to wait to convert once you land in the new state.
Yeah, I mean, I would wait a year for 7%.
Oh, yeah.
Wouldn't you?
Makes sense.
It's funny, but like back to the questions thing, people come in and I think they expect us to be like, well, if you move to Delaware, everything's fine.
Yeah.
And I'd never tell people that. Like, I'll say, yeah, you might pay less state taxes, but here's the downside.
Yep.
I always say, where's your family? Like, what are you going to do?
Is your doctor moving to Delaware?
Right.
We have people in Delaware that come back to Maryland for their doctor, 2.5-hour drive for their doctor visits.
Well, yeah, but I save, this much in tax, Brian. It's like that for me. It's like the guy that drives 30 minutes out of his way to save 2 cents on gas. Like,
Yeah.
You're not valuing your time correctly, sir. But anyway, move on.
All right. So this topic is an advisor asks a lot of questions. Is that a good thing? The answer is absolutely. Questions are a great thing. The hardest part is, how do you disclose your information to the advisor? Do you slow play it, give a little bit of information? As an advisor, I would say if you hold information back, you get a different answer. So that's a tough thing when you got to build trust first. If you don't have the trust, you probably don't want to make a decision. So that's a tough thing for you to think about. If you're listening to an advisor that you've not told everything to them, you don't want to listen to the advice because they don't know everything. If you don't trust them enough to tell them everything, you can't take the answer and act on it.
And when people start checking this out, I tell them, go get another opinion. I will go up against anybody that does this. Because I think that I definitely think I'm good at it. I wouldn't do it if I wasn't. But I think that I'm doing the best thing for the client in all scenarios. So for me, I got no problem with anyone shopping that anywhere. Take it wherever you like. Yeah. You're not going to get this, or you might get it in a different package, but you're not going to get this type of care somewhere.
Well, the hardest part is when a client becomes a client, a few years later, they come back to us and say, oh, this is a really good place. It takes time to understand the advantages of having an advisor and a company built around supporting you where you are.
Yeah, and the people that come over, they're like, well, why does Alex's office keep calling me?
Yeah.
Because he wants to talk to you. Like I have this one lady, she's like, is everything okay? I'm like, well, I haven't talked to you in a year.
Yeah, it's time.
I would like to talk to you twice a year, but I didn't want to make you upset.
Yeah. Well, they just want to know everything's okay, call when something's wrong, and we don't want to do that. We really, truly want to make sure you're going to be okay throughout life. And we need to know everything that's going on in life to make sure the money's really ready and proper.
Yeah, and to make sure that I'm doing the best job managing the money and the taxes for everybody and their scenario.
So it matters. So the idea that someone asks questions is a good thing. Today we've been talking about active money management. This is what we do for a living, so you don't have to figure all of this out. We help you. We love doing this. Planning for the unexpected or anything that goes on in the markets may or may not be your favorite thing to do. We know that. This is what we do. We want to make this as easy and as comfortable for you as possible, so that as we meet with you and put a plan together, it includes that. It's taken care of. It's planned for. And then it happens. You're like, oh, we planned for this, market up and down. We're okay. Perhaps you've been sold something regardless of whether you needed it or not. Not at AKERS Financial Group. With us, your retirement money follows your financial fingerprint. It's a retirement plan based on your unique fingerprint, and that determines where your money goes. It's not about us. It's about you. Give us a call at 833-WIN-RETIRE and schedule an in-person meeting with one of our team of advisors. That's 833-WINRETIRE, 833-946-7384, or visit our website at AkersFinancialGroup.com. Scroll down to the bottom of our homepage and schedule a meeting right there. Call 833-WIN-RETIRE or go to AkersFinancialGroup.com. Is your goal to make your money last a lifetime, or is it to take the highest risk possible? There is a huge difference. We'll explain when we return.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome to the fourth quarter of Winning in Retirement. Brian Akers and Alex Monk, certified financial planner practitioners from AKERS Financial Group, and we welcome you to the fourth quarter. Alex, you ready for the fourth quarter?
It's time. Yeah.
It's winning time. This is when you close out the game, when you bring the information that's needed most. The show today is called Active Money Management. Active money management, as opposed to stationary money management or set it and forget it money management. All those kind of concepts that are out there in reality. And you know what I'm talking about. You know if you've talked to your advisor. You know if your advisor's proactive versus I haven't heard from them in a long time.
Yeah, but I'm sorry to do this to you this late in the game, Brian.
Yeah.
What about those people that are just like, set it and forget it. Just buy the index.
Yeah. You mean index only?
Yeah,
All right, well, index only has been a good answer for a decade. The thing I always go back to is, do you guys remember 2000 and 2010? That was the negative S&P 500 for a decade. Now, the craziest thing is that stats are wonderful. I can tell you 2 stories from every stat, a good story and a bad story. Usually when the market drops way down, what you do is you count from the bottom to where you are now, and it looks really good. But if you had your money in like the S&P for the long term, 2010, you earned 0, actually negative for the whole decade. If you were retired and withdrawing money, you probably didn't have much money left over. So the reality of an index-only investment will not work for a retiree when it comes to taking distributions from that market. You need to have a better plan than set and forget. If we're younger and we're trying to buy and invest, S&P 500 is a stationary index. They add stocks once in a while. The general S&P 500 actually is not equally weighted. It's actually over-concentrated on the top side. So whenever those go bad, pulls the market down, but they end up replacing them and keeps the index rolling. But there is some finagling going on there, but it's not actively managed. So we're into the actively managed, or at least equally weighted. And then the passively, we love investing money in just some of the pieces of the indexes, not all of it at all the whole time.
And I think your answer right there is why you need active management and why it provides value. What you said was it just doesn't work when you're withdrawing money in retirement.
I don't believe it works well because you need to have some of it, but not all of it. And the sad part is people want the answer. Okay, I'm listening to this show. I want the answer, the only answer. Well, there isn't an only answer. I believe planning is the answer. People don't like to do the work for planning. That's why we can do the work for planning for them. Then you have to implement this plan on an ongoing basis. We all change. Our money changes. Our needs change. And the environment around us changes. We have to change our portfolios, change where we're investing money. Without that change and being proactive, you're going to be in investments like we have people pull into our office, they bring statements, and I can tell them what year they bought it. Oh, that's a 1998 fund. How'd you know that? Well, that's what everybody bought in 98, but you kept that forever, didn't you? You wrote it up and you wrote it down. It's just the way things are.
Well, and there's a bunch of reasons why that happens, right? People just don't know because they're a doctor. They do this, that, or the other. They don't manage money. And I find that when people are unsure or, they don't know, it's hard to make a decision, especially when it can be a big one. Like it can impact your life.
Well, these do impact our lives. And the fact that if someone's a day trader and they do well and grow the money and then they lose it all, it's the hardest part is when you make the money, it's keeping the money. And so this whole quarter is about the concept of making your money last a lifetime versus trying to achieve the highest risk return possible. So if you have a client that comes in with, or a new client, prospective client, with all their money in the market, what kind of things do you say to them?
I usually ask questions, right?
Yeah.
I'm like, do you know how much risk you're taking?
Right.
How do you currently manage your money? And a lot of times it's, I used to spend a lot of time looking at how the funds did.
Right.
And to me, that sounds like reactive.
Yeah, they look at returns. They can look at 3 month or 1 year.
But all the data you're going to see is about what happened.
Correct.
So it's done. So for me, and what we've gone through a lot of times is we get beat up if the S&P 500 is at all-time highs and we're lagging it by a couple percent. Well, why aren't you beating the market?
Right.
Well, I'm not set up to beat the market.
I don't think as people enter retirement years, you should have a goal of beating the market. The idea is to avoid big losses.
Right, and that's where you beat the market. Absolutely. Is on the downside.
Yeah, so the market, when it hands it to you, when the market has a bad month or bad number of months, like back in 2007 all the way into March of 2009, you saw 68% top to bottom, and that's a major downfall. And it took years to get back to where it was. The sad part is most people say, oh, yeah, I got out, then I got back in.
Yeah, everybody says that.
And I had some people come see us, I got out, and it was like 2020, and they never got back in.
Right, and then they're so scarred that they're traumatized from that.
Correct.
That they're like, well, I'm never getting back in the market.
Yeah.
Well, it's like riding a bike, but like not knowing how to do it.
Or it's like you with taking showers. You got back into enjoying water again. It was good of you.
Yeah, well, sometimes when it rains, it pours, they say.
It does. When it rains, it pours. What happens in when it comes to finances is our history should not dictate our future. The way we invest, a lot of times people get comfortable with one thing. They could be a real estate person, a CD person, they buy one stock type of person. The hardest part is to take them from where they are to diversify so that they know they can count on this money to make it last a lifetime. Yes, at AKERS Financial Group, if you want to retire and we're guiding you, we're going to rebalance and take less risk. We're going to make the lower risk side actually protect it so that there isn't a principal loss in the worst case scenarios. And we're going to ladder that out, diversify. It will be a little more complex. It's not going to be one portfolio, target date type concepts because we don't believe in the target date concept of funds that rotate into bonds for safety.
No, and that structure doesn't work.
It'll have moments of working, but it won't have those retirement withdrawals, basically trying to guide your money so that you maintain what you have. Because keeping your money is one of the biggest things you can do in retirement years is to know, hey, I still got my money I started. I actually grew it and I took all the income I needed. I love those meetings.
And I like to show people, hey, this is how we can still take risk. We're not saying, hey, take all your money out of the market and, I'm saying figure out what you need, make sure that we can produce that on a guaranteed level or, without taking any risk or with a low return hurdle. And then whatever you want to do with the extra money, we can, put it on red.
No,
but you know what I mean. It can be, risky.
Yeah. So one of the things that I come across, I see some clients where, let's say they have a lot of money invested and they're with a large firm, and the large firm has basically picked a couple portfolios. Now, they can bring in the manager, which we can bring in the manager too if we need to, but they'll come in and say, well, your $10 million is allocated in a 60-40 portfolio, and these are the funds we chose. And they're in basically all managed by that same firm, all manage each one. You're like, my answer usually is, well, is that firm the best at absolutely every category out there? I mean, my answer I found is no. These firms are usually good at one or two things. And as an advisor, what's been great in technology-wise is I can build a portfolio with the best in every category.
Yeah, from all those big firms. And then my favorite thing to do is have those big firms come look at our portfolios, and I want them to rip me to shreds.
And we do this with their portfolios
all the time.
Yep. And what do they say to you?
They usually find like one or two places where they can swap out a competitor's fund.
Yep.
But typically my allocation is good or better than their category benchmarks.
Yeah, and the reason is that if you alpha by picking the best manager, that means that you're going to make a little bit more money by having the best do it. The second thing you're going to have is that by allocation, you can actually dictate the risk you have. If we go in building a portfolio that's built to take 30% less risk than the market, we're not going to go up with the market that fast. We're also not going to lose as much when things go down. That's retirement. To make your money last a lifetime is keeping your money.
You're withdrawing for?
Yeah.
You need to earn at least that much.
Right. But the problem is we do see portfolios. People they ran for dividends and yield, and they're earning 8 to 10 on dividend yield. Their principal's dropping, and they're taking the checks out, and they're using all 8 to 10. There's nothing going back in, and they're wondering why their money's just dwindling. And it's all about what they own. And the sad part is some cases like that, they reach so far for yield, all their money's there. The broker that they're with constantly tries to buy the next highest yield one, which is usually at the high yield. That means the fund's already down. It's heading even further south.
Right. And that could usually be a value trap. It just depends on the fund too.
Absolutely.
But like back to your question, like, do you want to take more risk than you need? Usually when I see people that want to take that much risk, it's because they have done something wrong.
Yeah, they got to catch up.
Right.
I messed up. I lost $300,000. Now what do I do? Like, and I had a new person we were talking to, and like they wanted to time the market and get in and out. And I said, well, that's what got you in trouble before. And I said, this is what we do. And the sad part is they stayed with what they want to do, being time in the market, not go with us because they felt that's going to be their recovery, that they go for it one more time, and then they'll come back and be more conservative. I found that a conservative approach, the reality check of where you are, and then build that to the future guides you through this active management process to the answers that you want. And that is, I'm okay in retirement. I know where my checks are coming from. I'm going to be taken care of. My spouse will be taken care of. And I don't have to worry about it because I have an advisory firm that's actively managing for my sake. And that's what people need.
Yeah, and if you're trying to day trade, then you're clearly not on a riverboat cruise in Europe. You're clearly not doing all these fun things that you could be doing with your time.
Correct.
And that's what this money is there for your time.
Yeah, so today's show is really called active money management. Now, that is our way of working with our clients at AKERS Financial Group. So Alex and I today have spent our day talking about the process, the basics of how we do it. What you need to do now is act on that. Be active about the decision that you need to make. We look forward to meeting with you. We want you to win in your retirement by taking advantage of this opportunity to begin planning on an active basis with one of our team members at AKERS Financial Group. To schedule your free meeting with one of our team of advisors, go to our website at akersfinancialgroup.com, scroll to the schedule a meeting section, and let us know you'd like to schedule your free meeting. That's akersfinancialgroup.com. Or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person meeting with one of our team of advisors. Start planning for your retirement now. Go to akersfinancialgroup.com or call us at 833-946-7384. Thank you for listening. I'm Brian Akers from AKERS Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of AKERS Financial Group. AKERS Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. AKERS Financial Group and Archedios do not share any common ownership. Neither Archedios nor AKERS Financial Group provides tax or legal advice. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.